Hello, today we're going to be looking at the exchange rates of a country and looking at the causes, and it's really important we start with that word, the causes of changes to exchange rates. So causes of those changes. These are not the effects of exchange rate changes. If you want to look at the effects of an exchange rate change, you need to be looking at AD, you need to be looking at SRAS, and other things, amongst other things as well. This looks at why the exchange rate changes, principally the demand and supply of the currency. Now this is really difficult for quite a few people. The reason for that is that the supply and demand of a currency are actually what we call mirrored markets. And the actual Forex market, the foreign exchange market, is not something that you would possibly always understand. So the first thing we're going to do is talk about what this is in between our two countries. That is the market for foreign exchange. You can think of this most simply by thinking about what you do when you go to a bureau de change or a Travelex or a place where you change money. When I, for example, take my pounds, I'm going on a trip to New York. For example, I take my pounds, I give the pounds to the shop, and I take out dollars. I have therefore, when I put my pounds in, I exchange them to dollars, and then I take those to New York. By doing that, I leave pounds in the shop, which then when US tourists come to the UK, they can take the pounds that I left, exchange them for dollars, and go back that way. And so there is this market for foreign exchange. Let's talk about some examples of how that happens and how that works with the currency markets with demand and supply. Let's first of all talk about a UK export. Let's imagine that the UK has increased its exports. Exports have risen. Now, if we think about it, you're going to define this now. Exports are, from the UK, are US consumers, for example, buying UK goods and services. US consumers have dollars. So there will be a flow of dollars out of the US into foreign exchange markets. That means that this pool of dollars in foreign exchange markets is going to get bigger. I'm going to make that pool bigger. There's an inflow into that pool. At the same time, we take those dollars, I'm going to label that supply of the dollar. At the same time, I exchange. And by doing that, I demand the pound. And as a result, I'm taking pounds out of my pile in the foreign exchange shop. And so my pile of pounds gets less, and you'll see that happening there. As a result, we have now an imbalance of pounds and dollars. Or you could put it another way, I have excess dollars, excess supply of dollars, and excess demand of pounds. What's going to happen is those pounds are going to come out and there's going to be an inflow into the UK of pounds. Which, if you're taking that further, the inflow of pounds into the UK as an export is a component of AD, shifting AD to the right, creating economic growth and demand pull inflation. Let's look at what that means then for our markets, and let's track it round. So the first thing we've said is, let's start over on the right hand side with the dollar. This is going to be the price of the dollar in pounds. And what you always have to do is make sure that you have the right currency on the axis. This is going to be the quantity of the dollar. Now, you can make this even clearer by saying supply of the dollar and demand of the dollar. What we're going to say then is that as dollars flow out of the USA, as US consumers leave their dollars in the foreign exchange shop, that means that the supply of dollars is going to shift to the right, S1 dollar. And we're going to see, as a result, a fall in the exchange rate, ER for exchange rate, and an increase in quantity of dollars is traded on our foreign exchange markets. That there is known as a depreciation, as we are in a freely floating currency exchange rate system. Great. On the other side of things, at the same time, that action of buying pounds is the same action as supplying dollars. Or put it another way, supplying dollars is demanding pounds. So, on the market for pounds over here, this will be the price of pounds in dollars. This will be the quantity of pounds, not dollars. It's very easy to put quantity of dollars there. We're going to see that the demand is going to shift to the right. We have an increase in demand for UK exports. We need pounds. US consumers need pounds to buy them. And so there's an increase in the exchange rate as a result. And that increase in the value of the pound is called an appreciation in a floating exchange rate system. Great. You can see then two things happening at the same time. What I'd like you to do is to try that with the diagram down here and see what you get. An increase in US exports. Pause the video and give that a go. Okay, let's work it through then, the increase in US exports. So, in this scenario, we have US exports going to the UK. That means that the UK is buying US goods and services. We'll label that US exports. And we're just doing exactly the same thing as we did before, but the other way around. Now, for US to export to the UK has to take its pounds. It has to take pounds. There's an outflow from the UK, and we have to put our pounds into the foreign exchange shop. As a result, the supply of the pound will increase. That pool of pounds is going to increase as I leave my pounds there. I'm going to take pounds out of my foreign exchange shop. That's going to be the demand for the dollar. That was the supply of the pound. And as a result, we're going to see dollars flowing into the US, as you can see there. The result of that is in the market for the dollar, there's going to be an increase in the demand, just as we saw as the increase in the demand for the pound last time. And that is called an appreciation. Similarly, in the markets for, I should put the price of dollars in pounds, quantity of dollars in pounds. Lovely. Okay, in the market for the pound over here, I've got the same thing happening. The supply now of the pound has gone to the right because we've now left our pounds in the foreign exchange shop, and we're going to see a depreciation as a result. Price of pounds in dollars, quantity of pounds. And so we've got a depreciation going on this way. Right, great. So we've seen those effects there. But we can go on further, and we can actually go further and see what other effects there would be. So these two things would also happen with other sort of areas of the economy as well. We've just thought about exports here, but we could think about lots of other things as well. So we could also say over here, other effects could be, for example, the UK could have raised its relative interest rate. If the UK raises its interest rates, US savers over here will want to put their money into UK banks. To buy the pound, to put it into the bank, they have to supply the dollar, and therefore that raises the value of the pound and lowers the value of the dollar. We could also say that the UK has become attractive to FDI. US companies like Boeing, for example, an aircraft company, might see that the UK is really attractive. It has skilled labourers, it has good infrastructure, and it wants to build a factory. It wants to buy capital, and so to buy capital, it has to take its dollar profits, which it's making in the USA. It then leaves those dollar profits in a pile in the foreign exchange shop, buys the pound, and then puts it into the UK and builds a factory, essentially. Now, we could also say that the US has inflation. Now, if the US has inflation, that means that US goods and services become expensive. And if US goods and services become expensive, UK goods and services are relatively cheaper. As UK goods and services become relatively cheaper, you are going to see that US consumers take the dollar, they don't buy US domestic goods and services, they actually supply their dollars to foreign exchange markets to buy the pound so that they can buy cheaper UK goods and services. And that is another reason for doing that. Finally, and speculation is generally driven off all of the above. Speculation, if you expect any of the above to occur, a change in exports, a change in interest rates, a change in FDI, a change in inflation, speculators will try to trade the dollar first before these things have taken effect. And their aim is that they, expecting that the UK pound is going to appreciate, expecting that the US dollar is going to depreciate, they then go and buy the pound. So, to buy the pound, they take their dollars, leave it in the foreign exchange shop, and exchange it for the pound. Take their dollar, exchange it for the pound, and then keep their pounds in the expectation that they're going to go up in value. That then is driven by information and algorithms and all sorts of things driving that process. But information is key there. The information that Donald Trump tweeting or any celebrity, Elon Musk, for example, saying he's going to build a factory in a country, those sort of things are going to have a really big impact. The news of a trade war, news of inflation, employment, growth data, for example, will all have big movements in there. And just recently, political changes, particularly in the UK, are having bigger impacts on the exchange rate. And that is causing UK speculators with the UK-denominated pound-denominated assets to take them out of the UK and put them into other countries. Fantastic. The final thing I wanted to explore, and this is really the extension, and this is quite hard, is the idea of a freely floating exchange rate actually being a naturally automatic corrective mechanism to this imbalance in the foreign exchange market. And this is really interesting. So what we can see is that the increase in exports in this example has resulted in an imbalance. There's an excess demand of pounds and there's an excess supply of dollars. Now we can draw that on our graphs. So on this graph here, I can draw the excess demand of pounds. This is your quantity supplied after the shift. This is your quantity demanded. You have excess demand of the pound. And that's if reflected by these relative sizes of those two things there. Now what's going to happen is, as we see an increase in the value of the pound, you're going to see an increase in supply. Why? Well, as the pound increases in value, imports to the UK become cheaper. And as imports into the UK become cheaper, the supply of the pound, so movement along the curve, was going to go up, and we can see that there as we go to the new equilibrium. Equally, exports from the UK are going to become more expensive for Americans. And so the demand for the pound, D-pound, is going to go down. And you're going to see us going up to the equilibrium. On the right-hand side, that's a contraction, that's an extension. And as a result, these two pools of cash are going to balance. And so in a freely floating exchange rate system, you're going to see the exchange rate balancing changes. And that's why you see exchange rates constantly going up and down. Right. Thank you for listening. I hope that